Well, howdy, folks. It's Mike again, and we're going to do another Webby Rambles on Back to the Beginning or Back to the Basics, where we're just covering one small topic, a very important topic today, the power from pivot. But we're just going to focus in on that. We're not going to do any music stuff, any background stuff. I'm going to try to not tell any senseless stories, but there are a few stories that go along with this that we have to get into so you understand what it is. But this is a concept that Bill O'Neill, founder of IBD, my mentor, came up with long before I was born. As it actually came out of a trade that he did, I think it was 1961 in Certainteed, where he mishandled that trade and he wrote this rule around it that we, for a while, he would refer to it as the 8-week hold rule. Other times he'd call it the power from pivot. I use them interchangeably as well, but it was a rule designed around what happened with Certainteed, and so it wouldn't happen again. So we'll get into where you can find this in MarketSurge, how you use it, the kind of the unwritten rules around it, but it is a really great technique for holding stocks. You know, anyone who has read Livermore's works, Reminiscence of a Stock Operator, or How to Trade in Stocks, you understand how important the time element is to trading. And if you're familiar with my quick quicksand Grateful Dead rules, you know that that's really a modified time-based holding rule. So this was Bill's rule for holding. And again, it came out of Certainteed, which you can find it in How to Make Money in Stocks. You can find an example of that. And it was this high type flag that he mishandled and basically bought it exactly right. And then at a weak moment in the market where the market was doodling around and Certainteed was, he sold it just for a tiny gain. And then it went up and had this huge move and it really bothered him. And so he wrote a rule around it that was very simple. So that if you buy a stock and it goes up 20% or more within 3 weeks, and that's because his sample size of one, that's how Bill rolled, sample size of one, had gone up 20% within 3 weeks. And so that was a sign to him that it had this power that could last a lot longer. And so his rule was he was going to hold it for 8 weeks and then reevaluate it at that point to decide whether he wanted to hold it for a longer period of time or not. And back then, when he devised this rule, the long term capital gains time element was 6 months versus our current 12 months. So the market was very different back then because the tax rates were a lot higher. And so the tax selling was a big part of trading, where it really isn't these days. It's a very small element. Certainly when it comes to our style of trading, it doesn't come into play that much. But back then, it was a huge deal. And he ended up utilizing that rule the following year with a Syntax, which really made him his first fortune and put him on the map. And we'll talk about Syntax in a future episode, but that's just a background of this. Again, it was Bill's way of trying to find something that had power right out of the gate and to kind of say, you know what, this one is different. He's not going to just lock in his 20% gain. If a stock, he buys it, moves up, eventually gets up 20%, most of the time he would lock those in and just to try to compound those gains. But instead he would say, this is a special situation, so I want to hold it for 8 weeks. And then he would say that he would sell it down 7 or 8% from his purchase price. But if you really read between the lines in the book, he also says, and now this is venturing off into my interpretation of the rule, and we'll get into charts in a second, that, you know, I asked him point blank, I said, well, Bill, what happens if you buy a stock and goes, you're using this rule, goes up 20% within 3 weeks, and then it comes back down and it round trips on you and it goes down 7%. And he's like, well, if you bought it right, it wouldn't happen. I'm like, Bill, like, how do you answer that? So my answer to that was just put it in on the charts so you could start seeing all the times that it happened, so you understand the context of it, of how you use it, when you lean heavily on it, when you just use it as a bit of information. Because that didn't really fly with me. Like if you bought it right, it wouldn't go down that much. Well, markets roll, things happen. So that's why I put it into the pattern rec that I designed. And I've said in the past episodes, and that there is Webby Rambles on about how and why I designed the pattern rec for MarketSurge that you use every day. And we're working on advances to it right now. But, in there, I wanted to put a bunch of bells and whistles because I had no problem picking up where the cup was or where the double bottom was or what was a flat base and everything. But I wanted the computer to be able to give me a bunch of bells and whistles based off of that. And so that's where the power from pivot flag comes into play. And it is very powerful, and it is a great addition to the pattern rec, if I do say so myself, because it is what it is. So let me pull up MarketSurge real quick. All right, let me just get this going. So one place that we have this in is in the reports. Let's just blow up this reports here. If you go into the reports area, then go into the growth 250, and you go into the growth 250 pattern rec section and go down to power from pivot. So let's click there. Now, this is going to be a subset of the stocks that are in the growth 250. Again, something that I designed and I did a Webby Rambles on that, on how and why I designed it and how to use it. You can watch that if and when you have time. But these are the 22 stocks that have had a power from pivot at some point. And here's the date right there. So from either August 8th down to back in 2024. Let's see. So let's just look at the first one so you can get a sense of how it looks on the chart. And this is based off of the weekly on there, but the flag will show up both on weekly and daily, just depending on how the pattern rec. Sometimes you'll have one pattern on a daily and the other one on the weekly. Sometimes they're the same. That's not a great example. Let's go to find another one. Okay. So here's this Mercury Systems. Now let's find one that you guys probably know. Let's go down to BE. Okay, we'll just do BE for now. Corning is a little bit better. All right. So here's Corning on a weekly, and let's just blow this up a bit. So it's coming out of this consolidation, which is really a V-shaped cup, and it's measuring from the pivot, which it has here at 55.33, and is gone up more than 20% within 3 weeks. It will then show this little flag here with the percent. So if it had gone up 25%, then you'd have a 25 there, and if it was up 100%, it'd be 100%, and so on. And that was just a way of that I wanted to put in there to really just jump out at me so I could study this and study how they worked, and how many of them worked, how many of them didn't. But the concept here is, if you bought it there, not saying you buy it up here, but if you bought it at the pivot, at and around the pivot, and so you were up 20%, those shares you were supposed to hold for a full 8 weeks, all the way until the Friday, is how he would say it. And you can see up here in the top right, it's up 22% in 6 weeks. So I put that counter on there so you wouldn't have to count bars. Back in the day, I'd have to sit here and count 1, 2, 3, 4, 5, 6. And sometimes you'd mess up and miscount and have to restart. So we just put all these bells and whistles in there to try to make it as easy as possible. So it's gone up there. And then if Bill were looking at this, I would say, okay, it's up 20% within 3 weeks. I'm going to hold it for 8 weeks. Now at 8 weeks, then you're free to do whatever you want. And what he would typically do is have that time there of really kind of understanding the stock. He might be buying some additional shares of it or trimming, but those original shares that he bought at the pivot, he's holding and kind of locking those away for 8 weeks. And then at that 8 week point, he's going to look at whatever he owns and says, okay, well, I'm just going to lock this in and move on, or I'm going to sell a third of it, a half of it, and let the rest ride, or double up and start pyramiding. Not double up in one day, but start pyramiding and making it a bigger position. But it was really a kind of a cooling off period to kind of look at things. Let's take a look at it on a daily because they don't always show up as we saw with that other one. So this one wasn't up 20%. When a daily, it'll be 15 days, but you always want to toggle between the two. And legitimately, this was a cup with handle there that it happened to have two bottoms in it. So it was the double bottom slash cup, more of a cup with handle. That was your true pivot. So it's not really a true power from pivot because pattern rec isn't perfect. I got it about 80% accurate, and a lot of these consolidations that were truly cups with handles that I just couldn't get it to recognize. So you want to use your brain. You don't want to just blindly look at the pattern, especially if it's a consolidation. If it's breaking out of a cup with handle or a small flat base or something like that, or a double bottom, then pretty much you can use the pattern rec on there. Let's look at another one of these. So that was Generac. Okay, so here's one that would keep you in because you have this cup with handle, this giant cup with handle that went 30% within 3 weeks. At this point, you're 6 weeks into this, so you would have 2 more weeks in there to just kind of let it bake. And sometimes they go a lot further than what you would think. And that was the whole concept that he had, was just like what Livermore said. It's your sitting, not your thinking, that makes you the big money. And that was his way of approaching this. So I see the genius in this. I also see the flaws in it, which is the same way for every strategy, every rating, every indicator. There's genius and there's flaws, and you need to study them to understand them. I like my quick quicksand Grateful Dead rules better than this, but those aren't perfect either. So there's no perfect thing. So that's why you want to look at as many different rules and see which ones mesh with your style, and also kind of know the ins and outs of them. Let's look at a few more of these. So this one, that's kind of goofy, right? It just goes up there for a quick little trade. So it's not really a power from pivot in spirit. It's more just technically it did go up 21% and then came all the way back in. So, but again, that didn't trigger the 7-8% loss, which would have been down there from the pivot. Now, if you want to know where to find it in this book, it's in the 3rd edition. I think I was looking for it earlier to see where. Page 258 under my revised profit and loss plan, as well as a little bit before that. So if you want to go and read that portion of it in there. So that's the basics of the power from pivot. And I went through and I was doing a bunch of screening and I just found a bunch of other examples of power from pivot that I just wanted to go through. Let's see. So again, if you're looking for this, go under reports, then go to the growth 250 pattern rec, go down to power from pivot, and then you will see, and again, this is the subset of those. Now, what I did is I went through and I just put a bunch in a list, and some of these are good examples, some of them are bad examples. So let's just see from the most liquid ones. You know what? Let's do the most illiquid first and just move forward from there. So here's Rush Street. So you can go back to this base over here that it broke out of on May 3rd of 24, and you can see, okay, on the 3rd week, it was up 23%. So at that point, you're saying, okay, I got to hold this for 8 weeks. So that's 1, 2, 3. Well, let's just go there. Let's go out to about here, 14. Okay, that's 7 weeks. I need to go out 1 more week to the 21st. Okay, so now at this point, you're 8 weeks out, which you can see up here in this top right. You're up 29%. So now you look at it and you go, okay, is this something special? Is this something that I want to hold for longer or not? And that's a personal decision. I would look at it and go, man, I got away with murder because that's a really bad looking base, frankly, to be buying it out of. In this base before, it wasn't much better. It's just kind of wide and loose in there. So I might just take my money and run, do the Steve Miller thing. And you can see over here out of this double bottom, let's go back over there and Let's go to, what is that? February 21. Okay. This is 15 weeks out. So we're going to go back. What is that? That's 9 weeks. Okay. All right. So this is 8 weeks out from its double bottom base here that it broke out of, went up 29% within 3 weeks. Let's see if it popped up on a daily at all. Okay. And on the daily, it was up 55% within 15 days here. And it's telling you, okay, you need to hold this for 8 weeks. So let's go back to the weekly, and you're looking at this and just going, okay, we're at 8 weeks. This looks really powerful. I'm going to fill in the blank. Use the quicksand Grateful Dead rules. You're going to hold it as long as it stays above the 50-day moving average or the 10-week moving average, or as long as it stays above this week's low. Fill in the blank, and it could be all of the above. You could have little stop losses on each one, and let's just play this out. Go to the end of the month. And so at this point, it had gone higher, and there's no way to really foresee that this was going to fail like that. And then so you could just use any of your signals to get out there. And on the daily, you'd probably be seeing signs right there as this little breakup failure from this thing that was too small to be a proper structure, but it could have gone a lot higher from there. Let's go back to the current. Okay, let's go to the next one on the list. I'm just going to hit the space bar. So here's one on the daily that was up 31% out of this little cup without handle within 15 days or 3 weeks. So you hold it for 8 weeks and you see, let's go to the weekly. So 1, 2, 3, 4, 5, 6. Let's see if on this, maybe that was the 8th week. That would be bummer. Oh, that's the 9th week. Oh, that worked out. So that's your 8th week from there, and it's holding in 3 weeks tight out of there. And the prior little tiny cup, it was up 26%, so it has a lot going for it. Obviously, it has something really bad going for it, this bad break that it had in February of 24. But since you're in it at this point, I'd probably use the 10-week line. And we see that it fell, but I'm not going to be intellectually dishonest and say, oh, I'm just going to sell it all here because, and I could find 5 reasons right now of why I would sell it here, but that does you no good, because if I was going to sell it right there, I probably wouldn't have bought it in the first place for the same reason. So let's just go out 1 week and see how it breaks badly there. And really, that would have been your first real sign, a decisive break below your 21-day. That's not acting normal, at least you want to sell a decent chunk. And of course, I was breaking out under $10, so I wouldn't have bought it in the first place, just being frank, because that was a hard and fast rule of Bill's. Well, he had a couple exceptions, but not to buy things under $10. So, here, Life 360. Man, I totally messed this one up, which is such a shame. I didn't realize the product that this was when I saw the stock move like this. And it's a tile app, which are little things that I use all the time. I've got like 20 of them probably. And I give them out as gifts too. They're so great. If you lose your wallet, lose your bag or whatever, you put them in your cars. They're just little like GPS trackers. When we had the girls, Georgia and Violet, our dogs, we had similar things on their collars too. It's just kind of like a Apple AirTag. I actually use both devices just to have as a backup because, that's how I roll. So here, this broke out of this, kind of odd shaped double bottom here, which you could really say that the pivot was there. But regardless, you still had that power from pivot, and measuring it from this level there, it was up 24% within 3 weeks. So you want to hold it for 8 weeks. So let's just go back to where 8 weeks would have been. There we go. So here, this is kind of picture perfect. Power from pivot, you survive with those shares for 8 weeks. Now it looks like it just really wants to move, like legitimately. You have this nice little shakeout in there. Let's look at it on a daily. At this point, I'd probably say, my line in the sand is going to be there for most of it, and then the 50-day for the balance, and or mix in the quick quicksand Grateful Dead rules, and let's just go out to today. So right from there, you know, it this is was a genius move on Bill's part of this. What I love about it, even though I see lots of flaws, is the simplicity of it. And I think I was starting to mention it, but I went off on a different direction. One of the things that if you go through Bill's book, he will say, even though in there he would say that if you're using this power from pivot, you still use the 7 to 8% stop loss rule. He also has in another place, never let a big winner turn into a loser. So if you try to get put both of those together, they don't work, right? Because if something goes up 20% in 3 weeks, that's a big win, and you can't let it turn into a loser. But at the same time, he's saying that he's going to let this thing go down 7 to 8%. So the way I read that is, once you put this in there, you raise your stop up to break even, or maybe just up 1% to deal with any slippage or potential gaps in there. But that's my interpretation of it. Let's look at another one. So again, one here, up 25% in 3 weeks. It will allow you to kind of get through that 8 weeks. Now here's one where it just did not work at all. So let's see. Let's go to December of last year. We'll just go out to January. Go back a week. Okay, so this is 8 weeks from here. So if you're just implementing the thing where you're not going to, his original thing of letting it go down 7 or 8%, well, you've made it through the 8%. Really no harm, no foul on this particular example, because you're just flat, you're at zero, and then you just back out of it. Now, how I would have looked at this, interpreting it the way I'm saying, is once you came back down to here, that you've sold it, because it's no longer doing that spirit of the power from pivot. It doesn't mean you can't buy it back, just that where you're just locking it in for the 8 weeks. I personally would not do it that way. Let's just look at a couple more. Okay. Wow, this one has a bunch of them on there. Let's look at the most recent one and then kind of go back from there. So here, out of this cup with handle, up 25% in 3 weeks. 3, 4, 5, 6, 7, 8. So on your 8th week, you're right up there. And frankly, I'd be saying I'm going to, in all these cases, I'd be saying I'm going to use the quicksand Grateful Dead. But if I didn't use those, or if it was before I designed it, I would say until it breaks the 10-week line, closes below it. So you could either say that's here, or a little bit of both. And then on this one, look at that, it's up 62%. So the great part of this, and this is something we haven't talked about yet, let's go over here to 216.24, 216.2024. Let's look at this on a daily. Doesn't quite have the same base there. Okay, we'll go back a week. Go back another week. Okay, so on the first week, and this is the beauty of the hidden gem in this rule, is that once it's up 20% out of that base, you're holding that for 8 weeks. So, and it doesn't show up on the daily, but you can see it here on the weekly. It's up 29%, plus you've got the blue dot on there that we talked about on the RS line video. That was probably like number 32 or 33, something like that. But here, you're already up so much out of here. You might be tempted to just lock some in, because you had this gift, if you were able to get it right as it was going through there. But now it allows you to hold it. It forces you to hold it. So now you're up 52%. Now you're up 62%. And frankly, that's really hard to do, of just sitting and letting a gain bake like that. Now you've gone even further. Now you're up 66% in 4 weeks. Let's go another week. Now you're up 84% in 5 weeks. 54% in 6 weeks, but you're still holding it. 65%. And now here, your 8th week, and you're up 49%. Now, you didn't top tick it, but top ticking it, you would have just have gotten lucky unless you had a very specific rule. So now this is 8 weeks, and it's already come back into the 10-week line. So I'm just going to keep this easy and just say, okay, I'm just going to wait for a close underneath that to sell. So let's see if that ends up happening. Doesn't happen. Okay, there it happens. So just be out of it. That would be my rule. Another person might say, okay, a decisive break underneath your 10-week line. Well, that's 8% underneath your 10-week line. So yeah, it's kind of decisive. Now it's lower, and now it goes back up. But use your own rules for there. But I'm saying I wouldn't have been able to survive that. And there's some other ones in here. This one was a really good one. So same thing, up 36% just in 2 weeks there. So you go out about 8 weeks and you're over here, and it allows you to try to sit and hold this one. Let's go out to the next stock. Yeah, let's go back to that one. So this is another example. I mean, it's kind of, it had overhead, and probably wouldn't have been buying it down there. Well, I definitely wouldn't have been, because it was so low price. But that same concept there, where it's up 108% over here. So once you're up 20%, let's call it around here or so, that using this rule would force you to hold that, and you would go 1, 2, 3, 4, 5, 6, 7. So somewhere in this area up here is where your 8 weeks are, and so you'd have a massive gain implementing this one. Same thing here. That works beautifully. That one worked really well right here. That one didn't. So you round trip this one. So 38%. And what I would do is, once you're getting close to break even, I would go ahead and exit that. Or if you're doing it bill style, just wait until you're at either 8 weeks or down 7%. So you just pick the way, or you can always blend the two. This is Dave, another really good example, up 61%, and that would have kept you in there for those gains there. Modine. Why did I flag this one? Maybe it was on the daily. Honestly, don't know why. Must have been an accident. They happen. Okay, here's one that didn't, quite work out, but it didn't hurt you either. This one broke out of this odd-shaped double bottom here, went up 29% within 3 weeks. Hold it for 8 weeks, so it's 3, 4, 5, 6, 7. So around 8, and no harm, no foul. At that point, you look at it and say, okay, it's base building. I'm going to just sit with it. And now at this point, as it's attempting to break out of this base, you've got your lower cost basis stock in there. And what is going on that this isn't? Oh, this must have been older. Oh, that's why that other one didn't show up. I was looking historically. So here, let's go back here to 2020. Okay, so here was this example, and it came out. Let's go all the way to where it came out, just. Okay, so on that week, it's up 58%, and let's go over to the daily. So now it's up 58%, and you've got this IPO base. Again, if you want to know what an IPO base is or why I created it, and there's a Webby Rambles on that too. One of the early ones, it's both Google and the Google model book, as well as the IPO base. So this one up 58%. Wow, within 3 days, super powerful. So now you're going to have to hold it for 8 weeks. So let's go over to the weekly, and let's just go week 2. Now you're 105. Week 3, 127. Now you're up 157. You see that up here, right? Week 5, 97. Now 77. Oh, that doesn't feel good. 86. You've got to really feel it when you're doing these. Don't just look at it and go, okay, that happened in 2021. I can't trade it. It's paper money, blah, blah, blah. I actually feel it in your gut when you're going through these, because you want to feel that emotion, because in the battlefield, you're going to have a lot of emotions. Anyone who says you don't have emotions, you're lying to me, to yourself, to the mirror, whoever. It's not true. We all have emotions. So what you're trying to do is do the work ahead of time to trust your instruments to reduce the stress and reduce the emotions, but you can't eliminate them. So at this point, 86% in 7 weeks, and you just want to get through that eighth week. Ooh, only up 67%. So that's a bit of a bummer. So at that point, you're all the way down. You've tested you're testing your 10-week line. I would probably, and I don't remember what happened, but I'd probably put a lot, put that there because you've given so much back off the top that because of this rule, I would just give it that little bit extra because what's the difference between that one closed at, let's call it 42 down to like you give it two or three more points. That's what I would be doing. And let's just see how that played out. Probably stop me out. Yeah, well, on an intraday basis, it didn't, but on a closing basis, it did. So I'd probably split the difference. So I would have sold half probably. And let's see, then it bounces back a little bit and then starts rolling over. Okay, so that's a whole different, oh, that looks terrible now. What did that end up doing? Now I gotta know because I don't remember. Let's unzoom. Yeah, it rolled over. So it's not perfect, but it also, I mean, that's a really nice solid rule to just sit with and just go, okay, I'm up 20% now. I just have to wait for 8 weeks. And it allows you to kind of take that trade and set it aside and not have to think about it. Again, reducing your emotions so you can focus in on the rest of the stuff. Now, you still need to adjust the rest of your account based on what that's doing, to the risk in your portfolio, but at least it's one fewer decision that you have to make. Let's, you know what? Shoot, we've been going over half an hour, so I'm just going to find one more to do and we will wrap it up. NVIDIA reported today. I'm recording this on August 27th, which is why I'm wearing the Steve Ray Vaughan t-shirt. So anyone who knows about Stevie knows why. Hard day for us fans. 35 years ago, I guess. Yeah, I think it's 35 years ago that we lost him. Helicopter crash. Anyways. Okay, so let's go in and do the monster one over. You know what? I should do a Webby Rambles on this whole move. That would be fun. Okay, so let's go back down over here. So February 10th, 23. 10th. If you have any ideas for Webby Rambles on model book moves that you want me to do, let me know. I'm happy to do them. Okay, so this broke out of this little cup pattern over here, went up 23% within 3 weeks. So now you're sitting there going, okay, I've got to hold this for 8 weeks. So let's go through this. 1, 2, 7, 8. Okay, now it's your 8th week. You now have this deep, really good gain on there, 37% within 8 weeks, and allows you to sit with it differently and say, okay, well, I'm going to use the quick quicksand Grateful Dead rules, or I'm going to use the 10-week line, or maybe you even just say, as long as you don't go below there, you're going to hold it, something like that. And you can see this one over here. So 1, 2, 3, what is that? 1, 2, 3, 4, 5, 6, 7, 8. So that 8 weeks is somewhere around over here. So look, the entire market rolled over. That's why I just don't buy the whole thing of if you bought it right, it won't go down on you. It cracks me. Only Bill could get away with saying stuff like that. If I say something like that, people are going to call me out, and they should. So even over here on the back in 17, you can see where on the 3rd week over here that helped, and then that would have gotten you probably 8 weeks somewhere around over there, and then you would have had that cushion to try to sit with those shares. So it's a genius concept and everything. Is it perfect? No. If you know anything that's perfect, you can let me know, because I don't think there is anything out there. So that was, let's just go to the current date, see which other ones in there. So then you had another one in here, 24% within 3 weeks, 8 weeks, probably somewhere in this area. It allows you to sit through that. And then over here, 1, 2, 3, 4, 5, 6, 7. Wait, let's just do this last one exactly right. Let's see. That's the definite sell signal, 7, 26, 24. 7/26, 2024. And that's 10 weeks out. So let's go. Okay. So this is 8 weeks out. So if you were using this rule here, it's your 8th week and you can decide what to do. Frankly, I'd probably look at this and I would use the quick, quicksand, Grateful Dead rules, but you could also use just the low of that, which kind of coincides with that 10-week line as your line in the sand. And so let's just do 1 week at a time. Okay. In 1 week, it just gets there. So I would just be, exiting that. If I was using the Grateful Dead signal, I would still have some, if you know what I'm talking about there. And that's where the Grateful Dead signal comes into play. But you would have been selling some here with the quick and then quicksand and then the last 5% over there. So whichever rule works for you. And again, that's proof of how rules aren't perfect. There is no perfect rule. What you're trying to do is really understand. I'm going to go ahead and stop sharing. Whenever you start implementing a new rule, a new indicator, a new strategy, you really want to study it and you want to stress test it. You want to find out where all the flaws are. And so if you ever hear me saying something about, that I didn't like one of Bill's rules, it's no disrespect. It's just that I don't like all my rules. All my rules have problems. Everyone's rules have problems. I know I'm just on that theme today, but I just want you to recognize that nothing is perfect. And if you're searching for something that's perfect, there is no holy grail. So what you're doing is just shades of gray out there. And you're saying, okay, well, the 8-week rule, if I'm implementing it, I'm taking on this extra risk, meaning I'm locking that capital up. So then you have to adjust the rest of your portfolio, because if you're going to let something, let's say it's up 40% on you, and you're going to let it come all the way in to be down 7%. Well, that's a lot of risk in your portfolio. So it means you can't take on some other trades. Maybe you have to have a cash balance in your account to kind of balance that out. But that's more advanced things. We'll talk about that more. And if we start doing some, some portfolio management related Webby Rambles on. But I'm going to wrap it up here because I promised that these were going to be short. Now it's creep. It's already past 40 minutes. I'm going to try to see if the AI can chop out a bunch of words for me to make this shorter. So again, I'm still going to do my full episodes of Webby Rambles on, where I babble on about stuff. I tell long stories, explain the reasons why I'm doing these. I do my music episode at the end. I'm not getting away from that. I just wanted to bank a bunch of these short episodes in here between now and the end of the year, because I've got a lot of traveling, and I mentioned it on the other episode. I'm going to be doing some live events. I'll be speaking in San Francisco on September, I want to say the 27th. If you want to have details on this, just go to my Twitter handle, mwebster1971, forwarded or retweeted something from Hans, who's the head of the meetup group there in San Francisco. And he was nice enough to ask me to come speak there. And a lot of great speakers are going to be there. I'm happy to be involved with them. And Charles Harris is going to speak or have a little question and answer session on Sunday. I don't think I'm going to be around for that because I've got to catch a flight, but I'm going to be speaking on that Saturday. And so that is September 27th in San Francisco. So look into that if you're interested. Then the following weekend on October 4th, I'm really excited about this. IBD is putting on this workshop, a Founders Club workshop in Vegas at the Venetian. And at the end of the day, at least the way it's scheduled right now, Charles Harris and I are going to kind of wrap up that thing with an interview, a live interview that Arusha is going to do of the two of us in kind of a question and answer format. And so I'm really looking forward to that. I haven't seen Chuck in forever, and it'd be a lot of fun. We used to do workshops all the time together, and so many, countless, tons of fun. Then the last time I'm speaking currently this year will be on October 18th. Caruso was kind enough to invite me to speak at his event out in Fort Lauderdale, Florida, the 18th and 19th. So go to, and if you haven't caught his episode on the Webby's Ramble On, man, that was a hit. He did such a great job. I'm so proud of him. and he was nice enough to ask me to speak. It'll be that Saturday. And then on Sunday is the real deal. And Jason Shapiro, who's one of the market wizards in the, I think it's the unknown market wizards book. And he is just, man, he's so good. He is so good. I'm so privileged that he had me on his podcast not too long ago. So you can find that as well. So with that said, this is the end of this episode. Now remember, even though these are short episodes, you still have to pay your tuition, get your checkbooks out, get your Venmo out, get your cash out. No. All I want you to do to pay me back for this is to do something kind for somebody, something, an animal, an insect, anything, a person, family member, stranger, your best friend, your worst enemy. Do something kind, and we're going to try to slowly change this world around for the better. The more people listen, more kindness happens out there, and I'm counting on you to do it. So, till then, peace out.